Sumit Bhatnagar. He's a fund manager at LIC Mutual Fund, joining us on the show right now. Sumit, hi, good to be speaking with you. Tell us your own assessment of how 2025 is likely to be. Do you think it's going to be much different than 2024?
Thank you for having me on the show. See, what we need to realize is that we are coming out of a 4 years period of phenomenal growth, post-COVID growth, where we have seen our economy growing at 8% plus. Our corporate earnings in broader markets have been in high teens, and so have been the phenomenal returns in the markets. So if you see our large cap at index level has given around 15% returns on a 5-year CAGR, while small cap and mid caps have given almost double the returns. So now we are in a situation where our investors are so used to these type of superlative returns that uh, we need to uh, we need to bring down their return expectations a tad bit. Now we are entering a period of more of a normalization, as I would say. So over next 2-3 years, we expect the Indian economy, to grow at around 6.5, 7%. Likewise, our corporate earnings should also be somewhere around low teens over next 1 or 2 years, and that should set the tone for market return as well. It's what we need to realize is that we are entering a period of uh, slightly higher volatility. Multiple factors are driving this volatility. One obviously is the Trump presidency. He is the most unpredictable man, and leading a $30 trillion economy, the world's most powerful country, uh, adds a significant bit to the uncertainty. Secondly, the US fiscal and monetary policy would also be a key driver of volatility in the markets. Currently, if you see, US is running a 6.5% fiscal deficit. On top of it, Trump is talking about giving tax cuts and uh, providing stimulus to the economy. And at the same time, he's also talking about uh, imposing tariffs on US, on Canada, Mexico, China. So would be interesting to see how the fiscal policy and monetary policy pan out, because tariffs typically are inflationary in nature. So it would impinge upon US Fed's ability to cut rates going forward, and that is what we have also seen in his commentary, in the Fed governor's commentary in the last call, that where they have already given 100 pips cut and are now going to be more calibrated towards the rate cuts. So other than that, if you look at domestically also, so government had funded capex in a significant way over last 3 years, but now with fiscal consolidation on the way, uh, current fiscal deficit is expected to be 4.9%, and next year is expected to be uh, anywhere between 4.2 to 4.4. So your fiscal impulse is slowing down. At the same time, your revex is increasing because of welfare spendings by state governments and central governments, which actually is needed also to a certain extent. So we are entering into a situation where your GDP growth may slow down a bit.
Right,
Likewise, your
absolutely.
corporate earnings should also be uh, slowing
Slowing.
down, but still should be pretty reasonable.
Right,
We are entering a period of
there are a lot of moving parts actually, Sumit, and one of the big headlines is that we should brace ourselves for volatility when you talk about the year 2025, given of these confluence of factors that you've spoken about. But tell me now, how should one adjust their portfolio given the fact that you are going to see volatility in the markets? So which are the sectors that one should watch out for and actually look to place their bets in now?
So insofar as sectors are concerned, we think private sector banks are very well placed, reasonable credit growth, stable NIMs, stable ROAs, and no immediate threat of NPS spiking up. And at the same time, valuations at 1.5 to 2 times the book are fairly reasonable. That is one space that we like. Then pharma and healthcare is another space that we like. Uh, if you think of it this way, domestic demand continues to be stable. So also international demand for pharma, and with world aging, which is a reality, the demand for pharma and healthcare is only going to grow. And with opportunities like CDMO coming in, it can be a good medium to long term story, Indian pharma. Then Another sector that we like is IT. Uh, IT, we do expect, while FY24 was largely driven by your cost takeout deals and discretionary spends had dried up, we do expect discretionary spends to uh, come back significantly in next 2 years. So second half of FY25, FY26, we should see some bit of a recovery in IT spendings, and FY27 should be a better year for IT per se. Other than that, we continue to like capital goods and power transmission as a space, the entire value chain, where we see huge opportunity for next 5 to 7 years at least.
Okay, so power transmission, IT and pharma looks good to you. Thanks so much for joining us today.